Hey there, everyone. It's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday, everybody. Hope you guys are doing fantastic. Well, the trend has continued. Rates finished the week a little bit worse than where they ended last week. There was volatility this week. It all started on Monday with the announcement by President Trump that he was going to move forward with steel and aluminum tariffs on trade. And then that coupled with the resignation of his chief economic advisor, Gary Cohn, that caused the markets to react pretty negatively, both stocks and bonds. Usually when stocks react negatively, mortgage-backed securities and bonds do a little bit better because there's a flight to quality. But with the announcement of moving forward with trades and tariffs on steel and aluminum, that's inflationary because cars will cost more, refrigerators, everything made with steel and aluminum could cost more here because of the increase to those goods and services. And that's inflationary, and that's bad for mortgage-backed securities. Stocks didn't like it just because that would put pressure on economic growth in those industries. If it's costing more, they'll basically be able to sell less. So all in all, that is not good for the overall economy. And then coupled that with Chief Economic Advisor Gary Cohn resigning, that's instability, and so stocks don't really like that. So that actually, the market started off poorly on Monday. Didn't see a lot of movement on Tuesday, Wednesday, or Thursday because everybody was anticipating the jobs number, and that was a blockbuster. It just crushed expectations. There were about 313,000 jobs added to the economy. Expectations were closer to around the 200,000 mark, so that was much higher than expected. And that would typically be really bad for mortgage-backed securities and interest rates. But there were some things in the report that were actually fairly positive, one of which is the unemployment rate stayed the same at 4.1%. And the reason is even though there were many more jobs added to the economy, there were more people entering the workforce, so it all kind of balanced out and the unemployment rate stayed the same. And the real key component that the markets have been looking at is inflation, wage inflation pressures, and that actually cooled a little bit this month. It was at 2.9%, and it actually went down to 2.6%. So some of the inflation data within this actually helped the markets, and so we're holding our own here today. So there wasn't a whole lot of negative downside for interest rates on that one. But we'll keep you informed as to what's going on. The general trend is rates are just right now under pressure. Most of all the economic data that's coming out usually is going to be curbed for maybe having a negative impact. So we'll keep you informed as to what's going on. The bottom line is that here we're getting into the summer months and the home buying season. Tell your clients that now is a great time to act just because interest rates probably will be under some pressure here for the remainder of the year. They're better off in financing now than later, more than likely, and that with just rising values. And we just hit this, everybody probably saw it. We just hit in Denver, the average price is over $500,000 on a home. So not only will they be more expensive in the future, but the cost of financing is going to also be more expensive. So now is a great time to get out there. If you have any customers that need any information, want to talk about mortgages, please give us a call. If you're working this weekend, so are we. Thanks for joining me with Java with Jared. We'll keep you informed as to what's going to happen next week, and I hope you have a wonderful weekend. Talk to you soon. Bye-bye.